The U.S. economy grew last quarter. Stocks sit near all-time highs, and 92,000 Americans just lost their jobs. If those two facts sound like they contradict each other, they don't. They describe two completely different economies, and which one you're living in depends on one thing: where your income comes from. Here is what you need to understand. Last month's jobs report didn't just miss expectations, it reversed them. Economists projected 59,000 jobs gained. The economy delivered 92,000 jobs lost. That is a 151,000 job swing from forecast, the largest miss of 2026. And on the same day that number dropped, 3 of the 5 largest AI companies posted record quarterly valuations. One economy is accelerating, the other is contracting. And the mechanisms driving both are not random. They are structural, they are policy-driven, and they are operating exactly as designed. The pattern is clear. This is not a recession. This is not a boom. This is a split. And the architecture of that split is what Washington, Wall Street, and the media are all carefully avoiding. What happens next depends on which side of that line you stand on. And most people do not yet realize the line has already been drawn. 6 months ago, the story was simple. Inflation was cooling, the labor market was holding, the Fed signaled patience. Markets responded by pushing asset prices higher across every major index. Then the cracks started showing, not at the top, but at the bottom. January brought the first wave of federal workforce reductions. February saw retail and logistics layoffs accelerate as consumer spending softened in the sub-$75,000 income bracket. March delivered rising energy costs as geopolitical tension in the Middle East pushed crude back above key thresholds. And April's jobs report confirmed what the bottom half of the economy already felt: the floor is moving. Meanwhile, the top half barely noticed. Portfolio values climbed. AI-linked equities surged on earnings beats driven not by revenue growth but by headcount reduction. Every job cut that showed up as a loss in the labor data showed up as a margin gain in quarterly filings. The same number told two completely different stories depending on which report you read. And here is where it connects to something most people have not examined closely enough. There is a specific number buried in the proposed tax bill that tells you exactly who this economy is being engineered for. That number matters more than any jobs report. But first, you need to understand exactly how the April collapse unfolded. The April jobs report did not collapse evenly. The losses concentrated in 3 specific sectors: administrative services, customer support, and mid-skill data processing. These are not manufacturing jobs. These are not construction jobs. These are the roles that AI automation targets first: repetitive, structured, and replaceable at scale. Administrative services alone shed 34,000 positions. Customer service roles dropped by 22,000. Data entry and processing lost another 18,000. The remaining losses scattered across retail and logistics, sectors already running on razor-thin margins squeezed further by rising transport costs. Now look at the other side. The 5 largest AI-linked companies added a combined $480 billion in market capitalization during the same reporting period. Their headcounts dropped. Their margins expanded. Their stock prices climbed. The mechanism is direct. Every dollar saved on labor flows into earnings, and earnings flow into equity prices. The people who own those equities benefit. The people who held those jobs do not. But this is where the story changes. The job losses are not temporary. Previous cycles saw layoffs followed by rehiring as conditions improved. This time, the roles being eliminated are not coming back. They are being permanently replaced by systems that cost less and scale faster. The last 2 times this exact job stock divergence appeared in the data, what followed hit middle-income households hardest, and it took 6 to 12 months before anyone at the top acknowledged what was already happening at the bottom. That timeline matters, and the historical pattern behind it is more precise than most people realize. This is not just an American story. The split economy model is now the dominant structure across every G7 nation. But the US version is unique because of one factor: the sheer concentration of AI-driven market gains in a handful of companies that employ fewer people per dollar of revenue than any corporations in history. The top 10% of US households own 87% of all equities. When AI stocks surge, that wealth concentrates further. When those same AI systems eliminate jobs, the losses land almost entirely on households with zero equity exposure. The wealth transfer is not theoretical, it is mechanical. It runs every single trading day. Now layer in energy. Crude oil has pushed past $90 on renewed Middle East supply risk and Russian export disruptions. For a household earning $200,000 with a diversified portfolio, higher energy prices are an inconvenience. For a household earning $48,000, spending 11% of income on fuel alone, it is a structural cost shock that forces trade-offs between gas, groceries, and debt payments. This is where the strategic picture sharpens. The Federal Reserve, the White House, and corporate America are each operating with different incentives, and none of those incentives prioritize the bottom half of the income distribution. The Fed needs inflation down. The White House needs a growth narrative. Corporate America needs margin expansion. All three goals are currently achievable without the labor market recovering. There's one asset class that actually performs well during a split economy, and it is not what most people think. That answer requires understanding what decision makers are actually optimizing for. Here is what the data actually shows about how each power center is thinking. The Federal Reserve is trapped. Cutting rates would ease borrowing costs, but rate cuts do not create jobs that AI has permanently absorbed. What rate cuts do is inflate asset prices. Equities rise, real estate climbs. The households already holding those assets get wealthier. The households relying on wage income get nothing except marginally cheaper debt they are already struggling to service. The Fed knows this. Every internal projection models the same asymmetry, but their mandate is price stability and maximum employment, not income distribution. They will cut when inflation data permits, and the benefits will flow upward. The White House is managing narrative, not structure. The proposed tax bill reveals exactly where the priorities sit. The capital gains threshold adjustment, that one number buried in the bill, delivers 63% of its total benefit to households earning above $400,000 annually. Households earning below $75,000 receive an estimated 4% of the total benefit. That is not a rounding error. That is the architecture. The political logic is clear. Asset-owning voters are higher propensity voters. The bill is designed to reward the constituency most likely to show up. Corporate America has the simplest calculus. Every AI deployment that replaces a salaried role improves operating margin by a measurable amount. The average fully loaded cost of a mid-skill employee is $67,000. The average annual cost of the AI system replacing that role is under $12,000. That math does not reverse. No earnings call in the last 2 quarters has framed headcount reduction as a problem. Every single one has framed it as optimization. Most people stop the analysis here. That is the mistake, because the pattern this mirrors has a very specific historical outcome. But the other side tells a different story. The optimistic case is not weak. GDP growth remains positive, corporate earnings are strong, inflation is trending lower than its 2023 peak. The stock market, measured by total index value, signals confidence, and AI investment by this argument is not destroying the economy. It is restructuring it. Previous technology shifts eliminated entire job categories and created new ones. The automobile destroyed the horse industry and built a century of middle-class prosperity. The internet wiped out retail jobs and created the digital economy. AI, the argument goes, will follow the same curve. The tax bill, defenders argue, is designed to incentivize investment. Capital gains relief encourages deployment of capital into new ventures, new companies, new hiring. The benefits start at the top and work downward through expansion. This is supply-side logic, and it has a genuine historical track record in specific conditions. Here is the precise gap in that argument. The automobile created millions of jobs that required human labor. The internet created millions of roles that required human cognition. AI is the first major technology shift that replaces human cognition itself. The new jobs it creates require fewer people, higher specialization, and deeper technical training than the roles it eliminates. The replacement ratio is not 1-to-1. The data from the last 18 months shows it running closer to 1 new role created for every 4 eliminated. The 2006-2007 parallel is exact on this point. Headline indicators looked strong, institutional money was confident, and the bottom 30% of households were already in recession, 12 months before the top-line data admitted it. The divergence was visible in credit card delinquency rates, savings depletion, and small-dollar loan defaults. Every one of those indicators is flashing the same signal right now. That is not opinion, that is the data repeating. Here is where this hits your life directly. Start with gas. Crude above $90 translates to national average pump prices between $3.80 and $4.10 per gallon. For a household earning $48,000, driving 25 miles each way to work, that is $4,200 a year in fuel alone. That is 8.7% of gross income spent just getting to and from a job. A household earning $200,000 spends the same dollar amount, but absorbs it at 2.1% of income. Same gas price. Completely different financial impact. Now food. Energy cost increases do not stay at the pump. Diesel moves every piece of food in the American supply chain. When transport costs rise 15%, grocery prices follow within 2 to 3 weeks. Budget grocery categories, store brands, staple proteins, bulk grains, have already risen 6.2% year over year. Premium categories rose 2.8%. The cheaper you eat, the more inflation you experience. That is not a talking point. That is shelf price data. Jobs. The 92,000 lost positions concentrated in roles paying between $38,000 and $62,000. That is the exact center of the American middle class. These are not minimum wage roles. These are not executive positions. These are the jobs that pay mortgages in mid-sized cities and keep households one paycheck above financial stress. Savings are gone. The pandemic-era excess savings buffer that carried lower-income households through 2023 and 2024 has fully depleted. Federal Reserve data shows households in the bottom 40% now hold less liquid savings than they did in February 2020. Credit card debt has crossed $1.14 trillion. Delinquency rates on balances under $5,000, the small balance cards that signal real household stress, are running above 2019 levels for the first time. Borrowing costs remain elevated. The average credit card APR sits at 22.7%. The average new auto loan rate is 7.4%. A 30-year mortgage is still above 6.8%. These rates do not punish everyone equally. They punish the households that cannot buy outright, which is the same population absorbing the job losses, the fuel costs, and the grocery inflation. Now, that asset class that performs in a split economy, it is not equities, it is not gold, it is short-duration treasury instruments. When the economy splits, capital seeks safety with yield. 6-month and 12-month treasuries currently return above 5% with zero equity risk. Institutional money is already rotating there. That is not advice. That is observable positioning data from Treasury Direct auction results over the last 90 days. Two paths forward. Both are now visible in the data. Short term, next 30 to 60 days. If May's jobs report confirms the April trajectory with losses above 50,000, the Fed faces a forced decision point by June. Market expectations for a rate cut will spike, asset prices will rally on the anticipation alone. But the labor market will not recover on rate cut sentiment. The split widens. Consumer spending data will begin showing a visible fracture. Luxury retail and travel holding steady, while discount retail, dollar stores, and budget dining chains report traffic declines. Credit card delinquencies in the sub-$75,000 bracket push past 3.6%. Midterm, next 3 to 6 months. The escalation path runs like this. AI-driven layoffs continue through Q2 and Q3 as corporations lock in margin gains ahead of year-end reporting. The tax bill passes in some form with the capital gains structure intact. Asset prices climb further on rate cut momentum and earnings growth. Household debt in the bottom 40% crosses stress thresholds that trigger pullbacks in discretionary spending. By Q3, the economy that shows up in GDP data and the economy that shows up in household surveys are no longer telling remotely the same story. The 2007 parallel completes. The de-escalation path exists, but requires specific conditions. The Fed cuts rates by 75 basis points before September. Job losses stabilize below 30,000 per month. The tax bill gets restructured to include meaningful earned income provisions, and AI adoption slows, not because the technology stalls, but because public pressure and regulatory signals create friction. That combination is possible. It is not probable. The institutional incentives all point the other direction. Here is what the pattern says. Every time this divergence has appeared, in 2007, in 2019, the bottom half felt the contraction first. The top half acknowledged it last. The window between those two moments is where the most consequential financial decisions get made. That window is open right now. The question is not whether the American economy is strong or weak. The question is which American economy you are standing in, and whether you see the architecture clearly enough to act before the window closes. That is the real story, and it is still developing. If this video helped you see the pattern, subscribe now. The next data point drops in 30 days. You want to be here when it does.